Welcome to the deep dive. Today, we're jumping right into a really big question, one that's been making waves in the solar world. After what looked like a near fatal collapse last year, SolarEdge saw this, well, spectacular 200% recovery from its lows. So, has it truly turned a corner? Or is that recent 52-week high maybe just a mirage? Driven by sentiment, perhaps, especially with some pretty tough new regulatory headwinds coming in. That's exactly what we're going to unpack for you today. We are putting SolarEdge Technologies, Inc., that's SEDG, on NASDAQ right under the microscope. This is a deep dive into their fundamental business, their leadership, especially after that crisis, and yeah, their financial health. And just so you know, all this is based on public info available as of July 22, 2025. The share price back then was $31.08.
Yeah, and our mission today is pretty clear. We want to help you cut through all the noise surrounding this stock. Is SolarEdge's current valuation reflecting a real sustainable recovery, or is it more like speculative fever? Our goal is to arm you with what truly matters so you can understand this really complex, kind of high-stakes situation.
All right, let's get right into it then. We're starting part one, business understanding, management evaluation, and financial analysis. Let's unpack this. We're diving into the core of SolarEdge.
Exactly. We'll start by really understanding their business, then we'll look at the people leading the company, and finally, the financials. What underpins everything.
Chapter one, business analysis. So what is SolarEdge, at its essence? What problem are they solving for us?
Okay, so at its heart, SolarEdge designs, develops, and sells these things called DC-optimized inverter systems. They're for solar photovoltaic or PV installations.
ECM optimized inverters.
Tricky optimized inverter.
Oh, okay.
Think of it like the brain for a solar setup. Their main components where they make their money are power optimizers, inverters, and they have this cloud-based monitoring platform. But they've also branched out, into energy storage batteries, EV chargers, smart energy management stuff. They serve residential customers, commercials, and even some small utility scale markets, pretty much globally.
You mentioned power optimizers and DC optimized inverter system. Can you break down the magic there? How does that per panel optimization work?
Right. So the key is the power optimizer. Unlike traditional systems, SolarEdge puts one of these little boxes on each solar panel. And what it does is maximum power point tracking, or MPPT, right at the panel level.
Okay, MPPT for each panel. Why is that so important?
Well, it's crucial for maximizing the energy you harvest, especially if you have issues like shading on some panels, or maybe they get dirty, or one just isn't performing as well. With traditional systems, that one underperforming panel can drag down the whole string. With optimizers, each panel does its best, independently, so you don't lose as much energy.
Got it. So each panel is working at its peak. Then what happens to that power?
Right, so that optimized DC power then flows to a simplified central inverter. Its job is just to convert the DC to AC power for your home or the grid. And they have this proprietary cloud-based monitoring platform too, which gives you data right down to the individual module level. Very detailed. Plus, they've integrated other products like the SolarEdge home battery and EV chargers, all managed by their SolarEdge One software. It's becoming more of an ecosystem.
Okay, so what's the big value proposition here? Why do people choose this system over others?
It really boils down to a few key things. First, maximizing energy generation. More power means a lower levelized cost of energy over time. Better ROI. That's huge.
Better ROI, always good. What else?
Second, advanced safety features, like automatic DC voltage reduction for rapid shutdown. That's a big safety plus, especially for firefighters. Third, it gives installers greater design flexibility. They can use more of the roof, even complex ones. And fourth, that detailed monitoring improves system uptime and makes operation and maintenance O&M easier. You know exactly where a problem is if one occurs.
Makes sense. So where does SolarEdge actually stand in the wider solar market? Are they a big fish?
Oh, absolutely. A global leader. In their specific segment, module-level power electronics, or MLPE, they basically form a duopoly with Enphase Energy. It's pretty much those two at the top.
A duopoly. Wow, how big are we talking?
Scale is impressive.
Yeah.
Products in over 140 countries. By the end of 2024, they had their systems in over 3.7 million homes. And get this, deployed on over 50% of Fortune 100 companies' rooftops. That tells you something about their commercial reach. Would McKinsey even recognize them as the #1 inverter supplier in the U.S. for rooftop solar in 2024? So yeah, major player.
Okay, now here's where it gets really interesting for me. The solar industry itself feels like it's being pulled in two different directions right now. What's going on there?
You've hit on a key point. There's definitely a bifurcation happening. On one side, solar power is absolutely dominant as a new energy source. I mean, 69% of all new U.S. electricity generating capacity in Q1 2025 was solar. That's huge.
69%. Okay. But you said two directions.
Right. Because on the other side, the U.S. residential segment, SolarEdge's traditional stronghold, is actually shrinking. It was down 13% year over year in Q1 2025.
Down 13%. Why?
Mostly high interest rates, making loans expensive, and crucially, those federal tax credits are expiring soon. People are maybe holding off. But then look at the commercial segment. That's surging, up 4% year over year in Q1, projected to have a record year.
Why the difference?
Commercial is driven by different things. Corporate ESG goals, declining system costs making it attractive, the need for energy resilience, and don't forget the emerging demand from things like AI data centers. They need massive amounts of power, reliably.
Interesting dynamic. Okay, competitors. We know Enphase is the other half of the MLPE duopoly. What about others, like traditional string inverter companies or those big Chinese panel makers?
Yeah, good question. The MLPE duopoly is quite resilient. It's not just about the hardware, it's the whole ecosystem. Proprietary hardware, software, services. It creates really high switching costs once you're in their system. Traditional string inverter makers like Fronius or SMA, they compete, but often in slightly different segments, maybe simpler or larger utility scale projects. And the big Chinese panel manufacturers like Jinko, Trina, JA, Solar, they're huge in panels, but less focused on the integrated MLPE inverter solution like SolarEdge offers. It's a different value proposition.
Got it. Now let's talk about that elephant in the room you mentioned, government policy, especially in the U.S. Sounds like things have changed.
Change is putting it mildly. The regulatory environment in the U.S. has become, let's say, decidedly hostile in 2025.
Hostile. How so?
Well, the big one is the One Big Beautiful Bill Act and a subsequent presidential executive order. The most direct hit. Complete elimination of the 30% residential clean energy tax credit, Section 25D. And it's not phasing out, it's just gone after December 31st, 2025. Poof.
Wow, just gone. That must hurt residential demand.
You'd expect it to, yeah. Makes systems significantly more expensive upfront for homeowners. Plus, you've got the Liberation Day tariffs and expanded Section 232 duties on steel and aluminum. That increases component costs for manufacturers like SolarEdge. It's a double whammy, really.
Okay, given all this, the complexity, the policy changes, how hard is it for a new company to even try and break into this market? What are the barriers to entry?
They're substantial, really substantial. First, you need a ton of upfront capital. For R&D, for setting up global supply chains, we're talking serious money. Second, you need deep technological expertise and, crucially, intellectual property, IP. SolarEdge, for example, has this massive patent portfolio, 595 issued patents. That's a legal minefield for newcomers.
Almost 600 patents.
And third, building a trusted brand and a network of installers takes years. You need tens of thousands of trained installers who trust your product. That doesn't happen overnight.
So despite all these headwinds, the hostile policy, the competition, what gives SolarEdge an edge? What's their competitive advantage?
Several things still stand out. Brand strength is definitely one. They're consistently ranked top 2 most preferred by installers and customers. That's valuable. Cost advantages sometimes. For larger residential systems or commercial ones, their approach optimizers plus one central inverter can actually be more cost-effective than putting a microinverter on every single panel, like Enphase does. Then there are the network effects, that proprietary ecosystem we talked about. It creates switching costs. 3.7 million households are already in it. That's a big installed base. Plus that huge installer network, 74,000 trained installers, they tend to stick with what they know and trust.
Okay. Brand, cost structure, network, anything unique?
Yes. Actually, a key technical point. They're DC-coupled hybrid inverters. They're inherently more efficient for integrating energy storage, like batteries, because the DC power from the panels can go directly into the DC battery without needing multiple conversions back and forth to EC. AC-coupled systems, like those often used with microinverters, have more conversion losses, so better efficiency for battery storage. And here's that fascinating twist we touched on earlier, the end of the residential tax credit. It's expected to push the market more towards third-party ownership, or TPO models. Think leases, power purchase agreements, PPAs.
Right, where a company owns the system on your roof.
Exactly. And historically, SolarEdge has been very strong in that TPO segment. So paradoxically, this negative policy change might actually strengthen their competitive position relative to others who are more focused on direct ownership sales.
Wow. That's fascinating how a negative change could accidentally play to their strengths. Really interesting point. Chapter 2. Management evaluation. Okay, let's shift gears. Let's talk about the people steering the ship here, especially after what sounds like a really rough patch they went through.
Yeah, the leadership story is crucial here. SolarEdge went through a severe crisis in late 2023 and into 2024. We're talking collapse in demand, ballooning inventory levels, profitability just plummeting. It was bad. And it led to a significant leadership overhaul. The longtime CEO, Lando, stepped down in August 2024.
Stepped down, or was pushed.
The official line was stepping down to allow for new energy and leadership for the recovery. Ronan Farrer, who was the CFO, became interim CEO. And credit where it's due, they acted pretty decisively, restructuring, serious cost-cutting, layoffs, and starting to divest some non-core businesses that were dragging them down.
So who's the new permanent face at the top now? Who's leading this turnaround attempt?
They appointed Shuki Nir as permanent CEO in December 2024.
Shuki Nir. Does he have relevant experience?
He does. A key part of his background is leading a successful strategic turnaround at SanDisk, the memory company. So he's got experience fixing struggling businesses. And he's laid out a very clear 4-point strategy since taking over. 1, strengthen the financials. 2, regain market share. 3, accelerate innovation. 4, expand their U.S. manufacturing footprint.
Okay, a clear plan. What about communication and ethics? Any red flags there?
Communication seems pretty standard for investor relations. However, there is an ongoing securities class action lawsuit and related derivative complaints. They allege misleading statements were made during that downturn period. That's definitely a potential liability and a reputational risk investors need to be aware of.
Right. Good to know. Now, capital allocation. How have they been spending money, and has this new CEO changed that?
Oh, big time. It's been a dramatic reversal. Before the crisis, under previous leadership, they went on a bit of a diversification spree through acquisitions. They bought Kokam, a battery cell maker, SMRE for EV powertrains, Gamatronic for UPS systems.
Diversification sounds good usually? No.
Not in this case, apparently. These acquisitions proved to be a real drag on resources and profitability. They didn't integrate well, or the markets didn't pan out as expected. So now, under Nirna, the pivot is towards simplification. Focus on the core. A major decision came in November 2024. They decided to shut down the entire utility-scale energy storage division, which was built around that Kokam acquisition.
Shut it down completely.
Yep. Impacts about 500 employees, sadly, but it's expected to save around $7.5 million in operating expenses every quarter. That's significant, refocusing capital on the core solar business. Also worth noting, they don't pay a dividend. And share buybacks have been limited. They had a $300 million program that ended in December 2024, bought back about $50 million worth, but no new program has been announced.
Okay, so divesting, cutting costs, no buybacks. What does this mean for their efficiency with capital? How do we measure if this turnaround is actually working financially?
The key metric here is return on invested capital, ROIC. And the numbers tell a brutal story. In 2022, ROIC was a respectable 8.8%. Then it fell to 3.3% in 2023 as things started to wobble. But in 2024, it collapsed to a deeply negative 46.9%.
Minus 46.9%.
Negative 47%, roughly. That's not just bad, it signifies serious value destruction. They were losing nearly 50 cents for every dollar invested in the business that year. The trailing 12-month figures are still in that deeply negative range too, maybe negative 39% to negative 47.5%. So the new strategy, especially shutting down those loss-making divisions, is a direct attempt to fix this, to stop the bleeding and get ROIC back into positive territory. For investors watching this story, that ROIC number, its trajectory over the next few quarters, is probably the single most critical quantitative indicator of whether this turnaround is actually succeeding in creating sustainable value.
Chapter 3, Financial Analysis. All right, let's dig into those numbers that tell the story of SolarEdge's financial health or lack thereof recently.
Okay, starting point, market cap. As of our analysis date, July 22, 2025, is around $1.70 billion.
$1.7 billion. Okay. Now, revenue. You mentioned a boom and bust. Can you walk us through those numbers again?
Sure. It was quite the roller coaster. They grew impressively from about $1.46 billion in 2020 to a peak of $3.11 billion in 2022. Really strong growth. Then things stalled in 2023. Revenue dipped slightly to $2.98 billion, and the floor fell out in 2024. Revenue collapsed by almost 70%, down to $901.5 million, mostly due to that channel inventory glut and weak demand, especially in Europe.
A 70% drop, but you mentioned signs of life.
Yes, exactly. The first quarter of 2025 showed revenue of $219.5 million. That was actually a 12% sequential increase from Q4 2024. So maybe, just maybe, the first sign of bottoming out.
Okay, potential bottom. What about profit margins during all this?
Equally volatile, as you'd expect. Gross margin was pretty healthy back in 2020, 1.6%, but it eroded steadily down to 23.6% in 2023. Then in 2024, it plummeted to 92.8%.
Negative 92% gross margin. How is that even possible?
Massive inventory write-downs. They had to drastically reduce the value of all that unsold product sitting in warehouses. It wiped out any potential gross profit and then some. But here's a significant milestone for the turnaround story. In Q1 2025, they reported a positive GAAP gross margin again at 8.0%.
Back to positive, albeit single digits.
Exactly. It's a start. Operating and net margins followed a similar path, deeply negative in 2024, showing signs of stabilizing, but still negative in Q1 2025.
And free cash flow, that's where the rubber meets the road, right? Cash coming in or going out.
Absolutely critical. And FCF clearly shows the stress and the beginning of the recovery. They were FCF positive in 2020 and 2021, small amounts, but positive. Then it turned negative from 2022 through 2024. The cash burn peaked in 2024 at a deficit of $421.5 million, burning through cash fast.
Ouch. But did that turn around too?
Yes, and this is crucial for the bull narrative. They actually returned to positive FCF in the fourth quarter of 2024, generating $25.5 million. And they kept it positive in Q1 2025 with $19.8 million. So 2 consecutive quarters of positive free cash flow. It's a critical inflection point, shows they're managing working capital better and starting to generate cash again.
Okay, that positive FCF is a big deal. What about overall financial stability? Debt.
Well, they had a long history of profitability right up until that shocking $1.81 billion net loss in 2024. Looking at the balance sheet as of March 31st, 2025, the debt-to-equity ratio was 1.13, or 113.1%. That's elevated, reflecting how much the equity base was eroded by those losses. However, their short-term liquidity looks healthy. Current ratio was 2.04. That means they have about twice as many current assets as current liabilities, so they can meet their immediate obligations comfortably. As we mentioned, no dividend payments draining cash.
Okay, so after all that, the revenue collapse, the margin destruction, the negative ROIC, but now positive FCF, how do we even begin to value this company? What's it worth?
That's the multi-billion-dollar question, isn't it? The price to earnings, or PE ratio, is negative right now because of those huge losses over the last year, around negative 0.86. So it's not meaningful for valuation.
So PE is useless here. How else can we think about it?
We can look at profitable peers for context. Enphase Energy, their main competitor, trades at a PE of around 36. First Solar, a large panel maker, is around 15. This just illustrates the potential for SolarEdge's valuation to increase significantly. A re-rating if this turnaround is successful and they return to sustainable profitability. Big if.
Right. So how do we estimate its intrinsic value, considering the uncertainty?
We use a discounted cash flow, or DCF, analysis. This tries to estimate the value based on the present value of its expected future free cash flows. Given the high degree of uncertainty around the turnaround, the regulatory environment, all of it, our educational DCF model yields a pretty wide intrinsic value range. We estimate it's somewhere between $22 and $35 per share.
$22 to $35. Why such a wide range?
It's driven by the assumptions you have to make. How quickly will revenue recover? We assumed a sharp recovery initially, then tapering growth. What's the long-term terminal growth rate? Crucially, what discount rate do you use? We used a high rate, 12% to 14%, to reflect the significant risks involved here. And how quickly can they get operating margins back to historical levels? We assumed a gradual recovery over several years. Small changes in these assumptions can swing the value estimate quite a bit. That's why the range is wide.
Okay, that makes sense. A wide range reflecting high uncertainty. We've covered a lot of ground on the business and the financials. Now let's move into part 2. Market sentiment, ownership structure, risk assessment, and conclusion. This next section really gets into why SolarEdge is often called a battleground stock. Let's see how the market is feeling about all this.
Exactly. This is where the sentiment, the ownership, and the risks really paint a picture of why there's so much debate.
Chapter 4, Market Sentiment. So how are the analysts on Wall Street and the financial media reacting to this whole roller coaster story? Is there a consensus view?
Definitely no consensus. The prevailing sentiment among Wall Street analysts is actually pretty bearish, or at least very cautious. The overall consensus rating tends to be hold or even moderate sell. And the average 12-month price target, it's quite low. Recent estimates put it somewhere between $16.58 and $19.02.
$16 to $19, but the stock was at $31. That implies huge downside.
Exactly. Over 35% potential downside from the price on our analysis date, according to the analyst average. But here's the key. The range of individual analyst targets is incredibly wide, like $5 on the low end all the way to $41 on the high end.
$5 to 41. That shows massive disagreement.
Total disagreement. It reflects just how uncertain the outlook is. And the media narrative, just as divided. You see positive headlines focusing on that incredible stock surge, 120% plus in 6 months, hitting a 52-week high, talking about renewed investor confidence. Then you see other articles expressing deep skepticism, highlighting the Q1 net loss, even though revenue was up, the massive pile of unsold inventory still hanging around, the negative impact of the U.S. tax credit cuts, that ongoing class action lawsuit. It's two completely different stories being told.
So forget the opinions for a second. What are the actual market signals telling us, the hard data?
This is where it gets really fascinating, kind of contradictory. Short interest is exceptionally high.
Short interest, meaning people betting the stock will go down.
Precisely. As of the end of June 2025, there were 15.60 million shares held short. That represents 27.13% of the public float.
27%. That's huge. A massive red flag from bearish investors.
Yeah. Extremely high, yes. A very significant bet against the company's prospects. But contrast that with the stock's recent price action. As we said, the price, $31.08, was trading substantially above its 50-day moving average, which was around $20.89. And way, way above its 200-day moving average, which was sitting around $16.55. The momentum has been strongly upwards.
Okay, hold on. You have incredibly high short interest, a huge bet against the stock, combined with incredibly strong upward price momentum. What does that combination usually mean?
It creates what traders call a highly volatile and combustible situation. It's a classic setup for a short squeeze.
A short squeeze, explain that quickly.
Okay, so short sellers borrow shares and sell them, hoping to buy them back cheaper later. But if the price starts rising rapidly instead, they start losing money fast. To limit their losses, they're forced to buy back the shares they borrowed. This buying pressure from the shorts pushes the price even higher, which forces more shorts to cover, pushing the price higher still. It's a feedback loop, a buying panic among the shorts.
So the recent huge run-up in price might be partly fueled by shorts being forced to buy.
It's very likely a significant factor, yes. This rapid price movement might be, at least temporarily, detached from the underlying business fundamentals. The caution here is that once that short covering pressure eases up, the stock price could potentially revert back down closer to a level justified by the fundamentals, which, as we've discussed, are still quite challenged.
A very tricky situation. Volatile is definitely the word. Chapter 5. Ownership structure.
Okay, let's look at who actually owns SolarEdge. What are the big institutional players doing, and what about the insiders?
The ownership structure is also really interesting here. First off, institutional ownership is extremely high. We're talking 91% to 97% of the shares are held by large funds and institutions.
Almost entirely institutionally owned, then. Who are the biggest holders?
Big names. BlackRock is one of the largest, holding around 11.7%. But another major holder is GMO. That's Grantham, Mayo, Van Otterloo, a highly respected value investing firm. They hold about 8.5%.
GMO, value investors. Interesting. Are they buying or selling? And here's where it gets fascinating again. There's a divergence. BlackRock actually trimmed its position recently. But GMO, they increased their stake significantly around the same time. That signals pretty strong conviction from a very smart, value-oriented shop that they see long-term value here, despite the obvious risks.
Wow. BlackRock trimming, GMO buying big. What about the insiders, the executives, the board members, the people who know the company best?
Insider ownership overall is relatively low, maybe 2.4% to 2.5% of the company.
But are they buying or selling their own shares?
This is a significant bullish indicator. There have been numerous instances of insider buying over the past 12 months, and crucially, there has been zero insider selling reported during that period.
Zero selling, multiple buys. Anyone specific?
Yes. Notably, the independent chairman of the board, Avery Moore. He personally invested over $1.5 million of his own money to buy shares on the open market. Now, it's fair to note those purchases were made at prices below the $31 level we're using, but it's still a strong vote of confidence.
Absolutely. Insiders buying and not selling is usually a good sign.
So putting it all together, the ownership data paints this picture of a battle of the smart money, you could say. You've got a huge number of short sellers betting heavily against the stock, but you've also got a highly respected value fund like GMO and the company's own insiders placing significant bets on its recovery. This sharp disagreement among sophisticated players definitely contributes to the stock's volatility and means there's potentially elevated risk, but also potentially elevated reward.
A real tug of war among the big players. Makes sense. Chapter 6. Risk assessment. Okay, we've looked at the business, the management, the finances, the market sentiment, the ownership. We've seen the highs and lows, the opportunities, the challenges. So let's try and synthesize this. What are the absolute biggest risks that could derail this turnaround story for SolarEdge?
Let's pull it together using a kind of SWOT analysis framework. Strengths, weaknesses, opportunities, threats. For strengths, we've talked about their technological leadership, the DC-optimized inverter system, the huge patent portfolio, 595 patents, their global brand recognition, and massive distribution network, 74,000 plus installers. Good business diversification across residential, commercial, utility. And that growing U.S. manufacturing presence is also a plus.
Okay, solid strengths. What about the weaknesses?
Well, they're only just emerging from that period of severe financial distress. That massive 2024 net loss really hurt their balance sheet. They still have high inventory levels to work through, especially in Europe. There have been some past concerns about product reliability, although they seem to be addressing those. And they do rely on outsourcing for a lot of the manufacturing, which adds supply chain risk.
Right. Now, opportunities. What's the upside potential beyond just recovering?
The big one is the powerful secular trend towards integrated home energy solutions. Solar, plus battery storage, plus EV charging. Their DC-coupled technology gives them a potential edge there. That U.S. market shift towards TPO models, driven by the tax credit changes, could actually be an opportunity for them, given their historical strength there. The commercial and utility segments are expanding rapidly, and there's new demand coming from electrification, more EVs needing chargers, and potentially those energy-hungry AI data centers. Lots of growth drivers if they can execute.
Okay, lots of opportunities, but now the big one. Threats. What keeps management and investors up at night?
This is critical. Regulatory and political risk is arguably the most significant threat right now, especially in the U.S. That phase-out, or rather cliff-edge elimination of the U.S. residential solar tax credit after 2025 is a huge question mark for demand, and just a generally less supportive federal policy environment compared to a few years ago.
So policy is threat number one. What else?
Intense competition, absolutely. Constant price pressure, especially from large Chinese manufacturers. And ongoing technological innovation from their main rival, Enphase. They can't stand still. And finally, just general supply chain and geopolitical risks. We saw how disruptions impacted them recently. That's always a background threat for a global manufacturer.
You mentioned external factors earlier, too, like interest rates and tariffs. Can you quantify those impacts?
Yeah. High interest rates have clearly had a direct negative impact. They increase financing costs for solar projects, which suppresses demand. That was a primary cause of the downturn they just went through. If rates stay high, it remains a headwind. And the new U.S. tariffs starting in 2025. Management has actually put a number on that. They expect those tariffs to create a 4% to 6% negative impact on their gross margins just in the second half of 2025 alone.
A direct hit of 4–6% on gross margins from tariffs. Ouch, that's substantial.
It really is. It makes that path back to healthy profitability even steeper.
Chapter 7, Conclusion. Okay, so after digging through all of that, the business strategy, the leadership change, the financial roller coaster, the market craziness, the risks. What does it all mean? Let's bring it all together for you.
Right, let's synthesize. We essentially have two competing narratives here. The bull case versus the bear case. The bull case goes like this. A fundamental turnaround is happening. There's a new, proven CEO refocusing the company on its core, technologically superior business. Crucially, they're already generating positive free cash flow again. That's huge. And this view is supported by smart money, the chairman buying shares, a respected value fund like GMO adding to its position. Plus, that potential paradoxical benefit from the market shifting to TPO models where SolarEdge has historically been strong, that's the optimistic view.
Okay, that's the bull case. What about the bear case?
The bear case focuses heavily on the severe external threats. The U.S. regulatory environment is hostile. The tax credit elimination is a potential demand cliff. The new tariffs will directly hit margins, and the company is attempting this difficult turnaround from a position of financial weakness, having just booked massive losses that damaged its balance sheet. This bearish view is widespread. You see it in the cautious analyst ratings, the low average price targets, and that extremely high short interest. The bears are betting these headwinds are just too strong.
So bulls see a turnaround underway, bears see overwhelming external threats. Where does our valuation fit in?
Just to reiterate, our educational DCF model, trying to balance these factors, came out with that intrinsic value range of $22 to $35 per share.
Okay, and the stock price on July 22nd was $31.08.
Exactly. So as of that date, SolarEdge's share price of $31.08 falls right within the upper end of our estimated intrinsic value range.
What does that suggest?
It suggests the market, despite the risks, has already recognized the initial signs of the turnaround, the positive FCF, the new CEO, and is no longer pricing it for disaster. However, being at the upper end means the current valuation seems to be pricing in a significant degree of future success already. It anticipates the turnaround continuing smoothly and margins recovering substantially.
Meaning not much room for error?
Precisely. The current valuation appears to offer very little margin of safety if the turnaround stalls, or if those negative impacts from U.S. energy policy turn out to be worse than expected, or if competition intensifies further. So, the bottom line. This profound divergence between the stock's powerful upward price momentum, likely fueled partly by that short squeeze, and the deeply bearish fundamental indicators from analysts and short sellers. It makes SolarEdge a high-risk, high-reward proposition at its current valuation. Really one for investors with a strong conviction either way and a high tolerance for volatility.
A fascinating, complex picture indeed. High risk, high reward. So here's a final thought for you, our listener, to consider. Given this extreme divergence we've seen between the technical momentum pushing the stock up and the fundamental challenges and risks, how do you evaluate where the true value lies? And maybe more broadly, what does a situation like SolarEdge tell us about the dynamics of the market itself right now? Something to mull over, babe. If you found this deep dive valuable, please remember to like this video and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. Our members get priority deep dives on tickers they suggest, all for just €4.99 a month. And we've got a big project underway over the next few months. We're covering all of the S&P 500 stocks. Members get exclusive priority access for their suggestions there too. But hey, if you just want a one-off deep dive on a stock you're interested in, just drop us a super thanks on the video and we'll add it to our list.
And finally, the important disclaimer. This analysis was generated by an AI system purely for educational purposes. It should definitely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.